So you're ready to get that new car. You've done all the research, you've taken the test drives, and you finally picked the one. But then the big question hits. What is the absolute smartest way to pay for it? It's a decision pretty much all of us face, and today we're going to break it all down.
Right? There it is. The only thing standing between you and getting behind the wheel is a major financial decision. Are you going to go for a personal loan or a dedicated vehicle loan? They might seem kind of similar on the surface, but trust me, choosing the right one could save you a ton of money and a whole lot of headaches. And this is the classic car buyer's dilemma. The answer isn't always obvious, because really, it all comes down to your own financial picture. And maybe more importantly, what you really value most when you're borrowing money.
At the end of the day, it really boils down to this one thing: flexibility versus security. But here's the twist, and this is super important. We're not talking about your security. We're talking about the lenders. And once you understand their point of view, well, everything changes.
Okay, so to really get this, to really nail down the difference between these two loans, you only have to understand one single concept, and it's all about whether the loan is secured or unsecured. First up, you've got unsecured loans, and a personal loan, that's the textbook example. The bank is lending you money based purely on your credit history and, well, your promise that you're going to pay it back. There's no physical thing they can take if you don't pay, which, if you're the bank, is kind of scary, right? It's a pretty big risk for them.
And then, on the flip side, you have secured loans. A vehicle loan is the perfect example here. The loan is backed by an actual physical asset, the car itself. We call this collateral. If you can't make your payments, the lender has every right to come and take the car to get their money back. And boom, this slide just lays it all out, crystal clear. For a lender, a personal loan is a high-risk gamble. It's basically a deal based on your good name. But a vehicle loan? That's way lower risk for them because they've got the car as a safety net. This one little difference in risk, it dictates everything that comes next.
So how does this whole risk thing actually affect you when you're trying to get the loan? Well, let's put these two loan types head to head and check out the actual requirements. This is where you'll really start to see which one might be the better fit for you.
All right, let's kick things off with the big one, your credit score. Because a personal loan isn't backed by anything, lenders get really picky. They are often looking for a credit score of 750 or even higher. If your score is dipping below that, getting approved can be a real uphill battle. Next up, your income. Now this is where it gets kind of interesting. Where you live can actually matter. For a personal loan, lenders in a big city might want to see you making at least 25,000 rupees a month. For vehicle loans, that starting line can sometimes be a bit lower because, again, the car's value gives them that cushion of security. Okay, this table right here, it tells the whole story. Look at the personal loan side. You can see the lender being cautious, right? They want a higher credit score and a lower debt-to-income ratio. But now, flip over to the vehicle loan column. There's just more wiggle room all around. And it all comes back to that last row. The car itself is the lender's ultimate safety net. All right, numbers on a chart are one thing, but what does this look like for a real person trying to buy a car? Let's run a quick scenario to see how these differences play out when the rubber, actually meets the road. So let's imagine someone, right, a quality assurance engineer. They've gotten a good, steady job, and they are so ready to finally get their first car. Their financial profile is solid, but it's not absolutely perfect, which puts them right in that zone where this loan choice was going to make a huge difference. Okay, so here's their breakdown. A salary of 50,000 rupees a month and a credit score of 720. They've found the perfect car for 8 lakhs and they've got a 10% down payment saved up. Now that 720 score, it's good, but it's not quite in that slam dunk 750 plus zones for the easiest personal loan approvals. And here is where it all comes together. Look at this. With a personal loan, they get approved, sure, but only for 5 lakhs, and at a pretty high interest rate, around 11%. But with a vehicle loan, they get approved for 7 lakhs at a lower rate of about 9%. That is so much closer to the price of the car they actually want to buy. So let that sink in for a second. Just by having the car as collateral, you can get a boost of 20 to 30% on your approval amount. That's massive. For our engineer, that's literally the difference between having to settle for a different car and driving home in the one they really wanted. Okay, so we've looked at the nitty-gritty details, we've seen a real-world example. Now let's wrap this all up so you can make the absolute best choice for you. How do you decide which road to take? So let's just nail down the key takeaways. Point 1, vehicle loans. They are generally easier to get, they have lower rates, and they offer higher loan amounts, all because the car is security. Point 2, personal loans. They're tougher to get, but they give you total flexibility. The bank doesn't care what you do with the money. So the bottom line is this. For a personal loan, your credit score is king. For a vehicle loan, the car's value is what really matters. And that really brings us to the final question, the one you have to ask yourself. A personal loan puts the risk entirely on your financial reputation. A vehicle loan puts the risk on a physical thing, your car. So which of those risks are you more comfortable taking? The answer to that is going to tell you exactly which loan is the smartest move for you.